In this video, traders, we are going to look at how hard is it to change the markets that you trade. Stay tuned. Hey traders, a very warm welcome to you. Thank you for joining me. All right, so many traders transition from one market to another, something that I've done 3 or 4 times over my almost 20-year career. Started out with specific UK stocks, rotated then into futures, rotated into US stocks. A little bit more crude oil was a very high focus for me for a few years when it was active. And then basically, you sometimes transition because of a requirement based on your lifestyle. Perhaps you prefer the evening session. If in Europe, it's quite nice having the US session in the afternoon. You can do stuff in the morning, and then in the afternoon you have the trading session if you're that type of trader. Maybe you like the 24-hour market. Maybe you like, there's all sorts of reasons. Or maybe the market's just gone quiet. That's probably the biggest reason. The market has just gone very, very quiet. It's not offering the opportunity anymore. So you have a tough decision. You go, well, actually, you know what? I think there's more opportunity over here. I'm going to make the transition. That was certainly a couple of the reasons that I was pushed into different markets from my one focus, that the edge had gone. You kind of milked it for much it's worth. You made money in it, and it just changed. The sentiment had changed, the environment changed, the money flow had changed. So as a trader, your job is to go where the volatility is, where the money flow is, where the edge is. So you can't be stubborn about it, but just move on. So anyway, you've got to be careful, first of all, guys, before we talk about this, that you don't do it a grass is always greener type of thing. Oh, people are making money over there in US tech. Oh, gold looks like it's flying. Maybe I should be trading gold. You be careful that you don't just dive around. There's got to be considered, careful decision that, hey, I'm going to now change the way I trade or what I trade into this market because of this reason, this reason, this reason, and then come up with a process to do it. Some of the checklists that you should do, in my opinion, are things like look at the spreads and charges. Maybe if you're used to trading Forex, trading Euro USD, your spread's nothing. It's pretty much zero. And by the way, guys, if you like trading Euro USD or the Forex pairs, do check out our channel sponsors. A link to them in the description below. But spreads are super tight. Super tight. 0 pips plus a smidgen. You're almost trading for free compared to years ago. And then if you move to say UK stocks, thinner UK stocks, the spreads are going to be much wider because they're not as liquid. It's more expensive to trade, and so you've got to consider that. If you've got a very, very short term strategy, then some instruments just aren't going to work for you. They're just not going to work. Now, I've gone to 2 extremes there, but it does make sense to check the broker you offer, the broker you use offers the market you want to trade, and if not, go and find another one. And you also have to work how much it's going to cost you to trade. Because if let's say you're very, very actively scalping Euro USD or very actively scalping cable, very, very tight spreads, almost 0 cost, and then you go to trading and scalping, like I say, something like a UK stock that's a little bit thinner, or even a US stock that's a little bit thinner, wider spread, if you're back and forth, back and forth, back and forth, spread's going to get you, commission's still relatively cheap, but the point is your transaction costs are much, much higher, and your holding charges may well be much higher depending on what you're trading. So keep an eye out for that. This is operational stuff. Opening hours, goes without saying, if you're used to trading Forex 24/5, you're kind of holding positions, think, oh, it just closes at 4 o'clock in the morning. You go to do that and you've got Tesla, it's not going to happen. You can't do it. So just double check what your opening hours are and how that will affect the trade you've got. Example, if you're kind of looking for swing trading Forex, for example, you're holding yen over a 2 or 3 day period, you get filled in the early hours in the morning, and that seems to be an edge for you, capitalizing on perhaps Japanese Open, pushing the market in a little bit further direction or whatever it is. That's going to disappear if you're trading something else. You're trading FTSE, for example, it's not going to be work for you. So just think about, what when the opening hours are. Then you've got the event risk. So event risk is stuff like earnings are going to affect if you're trading stocks. Stocks are not going to be singly affected so much by economic data. They will push the whole market as a whole, but that's market risk in general going down further, a more granular nature to event risk. It's going to be earnings. If it's Forex, it's not earnings again, but you may have to look at some other countries. You're so used to looking at US markets. If you're trading stocks and you're going from stock to Forex, for example, you might be only focused on interest rates, NFP, and earnings for the stocks you trade. But Forex, you might now have to look at what's happening on the Bank of Japan if you're trading a yen pair. You might have to look at what's happening in the Bank of England if you're trading cable. You get the idea. So just understanding where the event risk comes from. Then we've got the drivers. So what's driving driving the market? How does it move? What people looking for? Are they looking for earnings and sector growth and company growth if it's a stock? Are they looking for this market to be strong? Is it, is it barometers, interest rates a barometer? Is it the Fed? Is it this? Is it that? What's the general driver? Don't have to be an economist here, guys, but you just have to have a good understanding of what the sentiment is and what's fueling things. Then the busy and quiet times. Handy to understand from an operational perspective the best times and worst times to trade if you're a volatility fiend, if you like volatility. And if you're not, still you want to look at the quiet times. So example could be, okay, if I'm transitioning from Forex to stocks, trading stocks at lunchtime is very different to trading them at the open or at the close or after earnings. There's distinct times and cycles when they're very, very busy. Same with Forex, when the underlying market opens, it tends to be a little bit before that actually, tends to be a bit of a rush of money coming in or out. And then the early hours of the morning when both of the sides of the pair might be asleep, it could be quieter and just sitting there chugging. Again, generalization, but you get the idea. Then we want to look at things like the price action of the market you're trading. The markets are very, very different, even within sectors and within industries. For example, how the S&P 500 trades compared to how say the YM trades is very different because the thickness, or S&P 500 compared to DAX. They're both indices, they're both big economic indices, but trade very, very differently because of the contract size and liquidity. DAX is much more spiky, S&P 500 much more liquid, much more, so it might break through by a few ticks and come back. DAX might just spring through and spring back. That's going to affect the way you position, your stops and your limits. Crude oil, sometimes crude oil very, very quiet for days and just rips off. So you've got this cyclical volatility, much tighter and broader with crude oil. Same with your stocks, same with this. So just look at the price action, eyeball it, get a feel for how it moves. Then what sort of strategies are going to work for the market you're trading? If you're shifting from Forex to stocks, you're going to have to accept some gap risk if you're trading over multiple days. Not so if you're trading Forex or going the other way around. But you get the idea. What's the strategy, what you're comfortable with, how you're going to employ it. And then the risk, I kind of touched on this earlier with event risk, but then I kind of touched on it just a second ago with gap risk, weekend risk, event risk. Certain stocks are much more vulnerable to news than others. They can be moving massive amounts based on some sort of news that's slightly related. Others are less impactful. So again, understanding the risk you're taking when you're taking. And also things like, if you're shorting stocks that are ripping up, just as an example off the top of my head, you've got real heavy risk, crazy risk. You could be shorting a currency pair, but that currency pair is probably not going to double or triple on you. It's pretty unlikely. Whereas a stock, certain stocks, you could have that happen if you're short. That's a lot of risk you're taking on. And the final thing, guys, is to come up with a plan. So if you're changing the markets you're trading, just come up with a plan. Speak to others who are trading the market you're trading and get some ideas. Say, hey, what are you trading? How do you trade it? What hours do you trade? I'm not saying you should copy these people, but it just gets you an idea, and you start to gather little tidbits of information and go, so-and-so said this, and so did this, so this person say that. And so you start to build an idea of what you're going to do moving forward in our Slack channels. Otherwise, you go on Twitter or StockTwits or whatever communities that are out there, and you can reach out perhaps to people, and even in this channel, guys, in the comments section, someone in there who definitely trades one instrument or another, who I'm sure will be able to help you out. But anyway, guys, that's transitioning from one market to another. All sorts of reasons why you want to do it, some ideas and checklists to watch out for if you're doing it from my perspective. Take care, guys. See you in the next one. Bye bye.